We are now live.
Yeah, so let me pull Fidelity because that's where I got the watch list.
Mm-hmm.
Do, 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 do. Come on, come on. I know you're a slow piece of shit. I get it.
And yeah, so it seems you were right to say Oxford Lane's a good sell now because I was waiting for their earnings report to come out, which just came out today, and yeah, it's not good.
Yeah, no, I was looking at some data in regards to their assets, and they haven't moved away from commercial real estate because they're not able to move away from commercial real estate right now,
Yeah,
and so it's a full sell.
yeah,
Um, and with us nearing a 50% vacancy of commercial real estate in the US right now, it's a big fucking problem that a lot of these companies, so this could cause Oxford to go bust out. We'll see if they can pull it back, then I'll change my mind on them. But as of right now, they're just not a good buy. So, so just to go down the ones that I'm specifically interested in right now. So, and I'm gonna ignore these two because I'm still researching this one and this one. This so I guess I won't ignore this one just because it's a very long hold. And honestly speaking, if you're interested in gold mining, this is probably if you're interested in a gold miner, this is probably going to be a great buy.
mm-hmm.
But that's given if their new round of assay reports comes out good. Um, they haven't released any new reports recently, but previously their assay reports at their new Papua New Guinea, it's called Great Pacific Gold.
Mm-hmm. Do you know
So
what their
um,
symbol is, or what their
if it's their ticker is FSXLF.
S
Great Pacific Gold.
XLF?
Yeah, FSXLF.
All right, let me take a look.
Yeah, they're an absolute tiny fucking thing right now,
28
and
cents
it's
a share.
because yeah. So just to explain why I'm interested in this one and why I'm keeping an eye on them. Um, so the country of Papua New Guinea, for those who don't know, there are some amazing gold mines there.
Hmm.
Some of the highest yield gold mines in the world are located in Papua New Guinea, and one of the things that this company is it's predominantly to do with its CEO. So the CEO and owner, mind you, he's not just the CEO; he's the owner of the company. He bought this operation that was basically dead in the water, and this guy kind of specializes in this stuff. He will look at assay reports and he'll look at yields and so on and so forth from these mines, and he'll identify, okay, this mine has great potential. It's just being ran like shit. And that's a normal thing with a lot of these gold mines is that they're ran like dog shit.
Hmm.
They're inefficient with their time. They're inefficient with their equipment. They're completely incapable of realizing like, hey, sometimes you need to take it a little slower and then ramp up before you start buying a shit ton of the big equipment. For example, if you follow the reality TV show, Gold Rush, you'll notice that they talk about it a lot, but they don't really give numbers and they don't really talk about like the intricacies. But they do mention it a lot in the TV show where they're constantly talking about fuel prices, they're talking about equipment prices, equipment maintenance, et cetera, et cetera. Well, so you're going to have the direct inverse here, where instead of dealing with the cold, you're dealing with the super humid, super hot, super wet conditions. So it's basically it's two sides of the same coin. And so this operation, and this guy has done this before. He had one. He's had multiple other operations that he's come in, picked up, for pennies on the dollar, and then turned them into actual money making operations. One of the previous company he just did this with a few years back. He went from, I believe it was around 50 or 60 cents a share for the company to now it's over like $7 or $8. And I cannot remember the ticker off the top of my head. I'd have to go back and look it up and try to find it again. But this guy, he knows what he's doing. He knows how to keep things within a margin that makes the mines profitable. So I am interested in this one from a personal basis because, again, I am interested in the actual gold mining side of things. And when you find people that actually know what the fuck they're doing, it can tend to have good returns. So this is a long hold, though. This is not something that you're going to buy and you're going to trade and do rapid shit with. You're going to buy this at bulk. You're going to fucking throw, me personally, if I had $1,000 to throw into it and just leave it, I would. That's just my personal take. Fucking hold it, and then eventually it's going to pop up. And given the assay reports that we're getting out of this mine, the last one was fruitful. We're talking something around like, what was it, like 7 or 8 ounces a ton, which is fucking insane for gold mining. And if you want to actually get a good indication of like what type of gold you're dealing with, you can, I recommend a YouTube channel called Mount Baker Mining and Metal. Dan over there, or not Dan, Jason, my bad. Dan's his friend. Jason over at Mount Baker does great work explaining this shit. He is a gold miner himself. He actually owns and operates his own mine, and they're doing their thing. And now they're doing hard rock mining, whereas this is more akin to plaster mining in the early stages, and then eventually they will potentially get into some more hard rock mining. But it just depends on how the mine develops over time, if they do start getting into some hard rock stuff. But this is going to be more akin to plaster mining than anything, which is it's just a deal. Plaster mining is basically you're taking the layers of soil and sediment and everything off the ground, and you're running them through to collect the gold that's strewn among those particles. So, long hold that I'm interested in. This is a personal thing for me. I'm not going to recommend it to anybody, but that's just, if you want to do your own DD and figure it out, that's up to you. But This is just a personal one that I have an interest in. The two that I'm particularly interested in right now, you got Orchid Island Capital. Orchid Island Capital, it's a mortgage securities investment company. Overall, their numbers are phenomenal compared to Oxford. Oxford, and I'm going to reference back to them quite a bit, actually. Oxford, they're over leveraged in commercial real estate, whereas Orchid is the inverse. They're primarily in residential shit. But one of the things is that a lot of their...
Aren't they a real estate investment trust?
Who?
The one you're talking about? Isn't that their... Aren't they primarily like an REIT thing?
Hold on. What is it called again?
Orchid Island Capital. Yeah.
Yeah, hold on. Let me pull up Grok and just make it easier.
Yeah, it's not an REIT, it's an RMBS, which is a residential mortgage.
Yes. Yeah, I couldn't remember what the acronym was. That was my bad. But yeah, they're again they're more in line with the residential side than they are like Oxford with the commercial side. They're analogous to Fannie Mae, Freddie Mac. So, and mind you, Fannie Mae, Freddie Mac are two of probably the most profitable companies in the fucking world if they were allowed to be unleashed from the conservatorship that they're currently under the U.S. government. Right. So, you know, Orchid is basically just a miniature version of those companies. Now, my primary interest with them is that basically they're just a healthier version in general than Oxford. Again, the residential side is a lot healthier right now than the commercial side, and when it comes down to the reason for that is, you know, a lot of people might be like, oh yeah, residential prices are super high right now. I'm like, yes, so are commercial prices. Commercial prices are absolutely fucking insane. The only time you're seeing low commercial prices is in places where businesses have fled. And much of the reason for that is because the commercial side of things, basically a lot of companies took out debt to buy these buildings. And then the Federal Reserve said, hey, by the way, the era of cheap dollars is over. Don't assume that you're going to be able to get cheap dollars for free anymore. And that dried up the ability for most of these companies that own these buildings to refinance. Whereas when you're talking about refinancing within the residential side of things, if you have the ability to refinance, people will refinance. But a lot of people didn't refinance in the past few years. The refi rate has been astronomically low for most people across the board because everybody got those really sweet interest rates back in the day during COVID, and they're like, nah, I don't want to give that up. Right. So they're just like, nah, I'm not going to refi, which as long as they're able to make their payments, they're golden. Whereas these large investment companies that bought these commercial properties that are now having vacancy issues, they can't refinance because they can't. The bank is looking at them like, you're at 50% vacancy, bro. Like, what do you want me to do? Like, your rate's going to be absolutely astronomical, and so their rates are like doubling or tripling, and they can't sustain it.
Right.
So that's a key thing with the health between residential and commercial real estate right now is the ability for these investment companies to refinance their loans is just non-existent, especially with the Fed funds rate set as high as it is. So definitely the one that I'm keeping an eye on in lieu of Oxford. Again, you know, just the simple fact. Which, by the way, speaking of, because you apparently you went and listened to the earnings call.
Yeah.
I haven't had a chance to go and listen to it yet. I wasn't up. I wasn't going to bother with it first thing in the morning. I was going to listen to it later tonight.
It's a mixed bag, but the two things that are the worst are decreasing NAV. The net asset value dropped from 430 something to 412, and they're cutting their dividends from 9 cents to 8 cents. There was some earnings growth. Like it's again, there was some good stuff, but those were the two things that made me say, okay, I'm out.
Well, okay, so that tells me that they're like, okay, yeah, we definitely need to keep capital in house because if I remember correctly, they had said something about 417, 418, and if it dropped to 412. That's a missed mark right there.
Yeah.
If they were expecting 417, 418, and then it drops below that, like, yeah, no. The company itself is probably fine, but it's their investments that are the problem.
Yeah, they also dropped their net they had predicted a net investment income of 24 cents per share. Sorry, 26 cents per share, but it was only like the earnings call. They said it was only 24 cents per share, so they missed that by a couple cents.
All right.
But the investment income itself was up a couple. It was prior it was 121 million. Now it's 124. But yeah, the net asset value dropped to 412, and but
okay,
the total value of the assets rose to 2.75 billion from 2.52. So, and yeah, so again, mixed bag, but too much now.
Yeah, definitely not one. Yeah, definitely not one that you buy into right now.
Yeah.
Like maybe in 6 months, they'll be able to rebound a little bit, especially if Scott Bessent becomes the Fed chairman and he does a preliminary cut of like 25 basis points. Maybe, in 6 months, but as of right now, if you were in before this point,
yeah.
If I remember correctly, my dad said he had lost like 700 something on his batch of Oxford that he had. I told him to just hold on to it and not to buy anymore personally. Mm-hmm. Again, and I hate that we have to fucking, I guess, hey, make sure to make it clear on the beginning. Not financial advice. This is us discussing our financial planning and our ideas and just throwing it out there for people to consider and whatnot. What you do with your money is your own fucking business. But when it comes to my family, we kind of tell each other what to do to a degree because we're all angling to start up a family trust that we all pay into, and so we're all trying to manage things as a group rather than just everybody go off on their own. So I told my dad, like, hey, don't buy any more right now. It's not a value buy. And that's when I started doing the hardcore research on Orchid. And again, Orchid just, heavier, a little heavier on the price, but the dividends are, they manage the dividends really well. Like they're low when they need to be, they're high when they need to be, et cetera, et cetera.
Yeah. So one last thing I forgot, probably the most shocking of all from that earnings call. In September, they're going to be doing a reverse stock split of 1-for-5 reverse stock split, which I'm not sure if you know what that means, but
yes. Okay, yeah. So they're doing you said a reverse split in September?
Yeah, specifically a 1-for-5 reverse split. So it means shares will be cut by a factor of 5.
Jesus Christ.
Yeah. That was the most.
Yeah, they fucked up. They fucked up and issued too many shares. They fucked up.
Yeah. Thankfully, I got out immediately after hearing that because the price has just cratered today. From where
I haven't looked at it today.
It was at like 415 overnight. Now it's down to like 350.
362 right now. Holy shit. Yeah. Okay. But yeah. So the next one is Nordic American Tankers. Mm-hmm. Most people probably, if anybody who has any fucking clue, probably cringed a little bit. Like, why would you invest in tankers, given the overall state of the world? However, here's the thing. If you're investing in companies that have the scale of operations that make them profitable while also basically make them profitable while making them manageable, you tend to get a better return overall.
Yeah.
And so overall, what I personally when I look at Nordic, I look at how many ships they're running. So they're running 30 Suezmax category ships. So Suezmax is the biggest ship that can possibly go through the Suez Canal. Which now that I think about it, I'm like, wow, the Suez Canal needs work. But at the same time, they're running, a fleet of 30 ships, which, 30 might not sound like a lot, but it's a decent amount for as quote unquote small as a firm as Nordic is. So, when you think about the, some of the bigger companies out there that are running cargo and whatnot. Yeah. So overall, a really, in my opinion, given their financials, given what they bring in every year, the fact that they're able to easily meet their obligations when it comes to their debts, short-term debt, they were sitting at about 112 million. And all of that debt wasn't like operational stuff. It was, hey, we're financing our tankers. And they did just replace a few of their tankers within the past few years, creating a situation where it's like, yeah, they got a decent chunk of short-term debt, but at the same time, they're able to service it. Yeah. So it's like, not that big of a deal.
And looking at there are some interesting things there. They have over the past year, they have an earning per share growth of 23.8%. That's pretty good. The price earnings ratio 8.6, relatively good. Seems they're. Let's see. So they're 15th in their industry for price to earnings ratio is relatively good. Ninth in their industry for dividend yield at 10.68%. What else? Their price to book value 1.14. That's about mid in their industry, but still relatively good for like the market as a whole.
Well, again, you're talking about a smaller scale company, so yeah.
Their price to sales is a bit sketchy though. The price to sales is 1.75. They're like bottom 65 out of 102 in their industry.
I will. What's the time frame on that?
It has the time frame for that is the trailing 12 months. So the last
so it's been the last year. You have to remember, cargo prices were absolutely fucking insane. Insurance rates and all that they were absolutely insane last year, and the year prior. So there were a lot of big issues with that. I don't know what current pricing looks like. I haven't seen a chart for it. I just saw 2022, 2023, and 2024 in their filings. And overall, like from 2022 into 2023, like there was a distinctive drop overall in their earnings because, pricing and everything had just gone absolutely insane. And then 24, it rebounded a little bit, but not like a lot. And then now with 2025, again, we'll get that we'll get the annual report at some point in time, probably in February, and we'll be able to see.
Here's something I saw that worries me a bit about this. They have a high M score. M score, for those of you who don't know, is an earnings manipulation risk. So there are indicators there. Again, maybe they're not, but the indicators that exist indicate that there is a high likelihood they are fudging their books in some way.
Well, okay, so to be fair to Nordic, but also to be fair to you in this regard, we are talking the shipping industry, so they don't want to make it look like things are as bad as they are without basically the whole idea of, you don't want to make people panic, but you also have to tell them like a nugget of truth in order to make sure that they understand, like, hey, shit's a little rough. So I wouldn't be surprised, like, when does that rating have like a time frame associated with it, or is that just like a constant thing?
So the rating is based on the last year. So it's another like trailing 12. Like if they meet certain metrics within the last year, then it's either like a check mark or a X, and there are not There are 9.
Yeah.
There are 9 things that can either be good or bad, and a bit more of them are bad than should be. But yeah.
Well, again, and you have to understand one thing about the tanker industry overall, or the shipping industry overall, is that it's gotten fucking hammered in the past, 12 months. It's been hammered the past 24 months, the past 36 months. Like, you go back to you look at shipping back into 2021. So honestly speaking, I wouldn't be surprised that they probably could be fudging their books a little bit just to be able to get a bit of a better rate on their financing for their ships, because again, as I pointed out, they did replace a couple of their older ships within the past couple of years. They just took delivery of within the past 3 years now. I think it's like 3 or 4 ships they just took delivery of.
Yeah.
And then starting in 28 until 21, they're going to have to start taking delivery of a further, I think, 5 or 6 ships, because they are the lifespan on a few of their other older tankers are going to start coming due. And then they'll be good until like 35, 36, something like that. Mm-hmm. And then that's when they have to go through tranches of replacements in order to be able to maintain operations while also replacing their older ships.
Right. As for the other scorers, they have an F score of 5, which that's basically the F score is an indicator of the health of the company. 5 out of 9, so they're just in the middle. Not good, not bad. They're just reasonable.
and
it implies reasonable and stable. Yeah.
Their earnings did take a pretty big fucking hit from 22 to 23, and then they only slightly recovered. I think if I remember the chart correctly, it dropped to like 38 million a year,
right,
or something like that, to 44 mil. Like they didn't recover fully from 2022.
Right. Well, that leads into the final score I'm looking at here, which is the Z score, which is the bankruptcy risk, basically. And they have their Z score of 2.52 out of 4, indicating that there is a moderate risk. They're at moderate risk of bankruptcy. And the caution should be...
Yeah. And honestly speaking, I would love to see the data on other similar sized shipping companies in their category, just to see what the numbers say in that regard. Because and thank you for bringing that up. Honestly speaking, I had not thought about looking at that score specifically. Mm-hmm. I would love to. I'll sit down and try to identify some companies that are kind of in their weight class and see what we're looking at. Because if that's like just a normal average across that weight class when it comes to shipping companies, then it's like, okay, so it is what it is.
So the main reason why its Z-score is not great is that the thing it fails is its working capital over total assets. So if its working capital over its total assets is greater than 0.23, that's good. But its working capital over its total assets is 0.06, which is bad. But it does seem. Let's see. What are the things it passes? So let's see. So its value compares. I am gonna
point. Sorry. Real quick, I am gonna point out that this is a Norwegian shipping company. Oh. So yeah, don't be tricked by the whole Nordic American. The only thing that's true about the name is Nordic. It is a Norwegian shipping company. So there could also be EU stresses because of the pressure that's being put on Norway. Remember, Norway just announced massive taxes on combustion vehicles in general, and you also had the International Maritime Organization announced a new tranche of restrictions on high sulfur fuels being used on ships. So they can't use any of the cheaper fuels because they're under the auspices of the IMO. They can't use any of the cheaper fuels that they would normally be able to use otherwise. So there could be some stresses from policy making that are going on as well. And that's a big thing in my opinion. That's kind of where I'm looking at most of this stuff is the policy making. Like, okay, there's stress there, but at the same time the company's doing as best as it can under those circumstances. Like, again, let's please, dear God, let's make oil investable again.
Yeah. The one final red flag here I see that is worth bringing up is their sales growth over the past year. Their sales growth has been negative 37.3%, which puts them out of 100 total oil and gas related equipment and services market, puts them 94th, and out of the entire market, they're 4,022 out of 4,300. So that is
okay. So they're having problems. Well, and I wouldn't be surprised to find out that they are they're victims to the they're probably victims to the Chinese boom on shipbuilding. Because Chinese companies, they are cranking ships as fast as they can, and so they're trying to ship stuff as much as possible. So they're probably having a problem securing contracts as well. If that is the regard, they're probably getting pushed out of the market via the Chinese side of the equation.
Yeah, could very well be.
So a couple others that Great Elm Capital is one that I've kind of kept an eye on previously. I need to do some more some new research, I should say, not more research, but new research on them to see where they're at. They've, if I remember correctly, the ticker is GECC. If I remember correctly, when I first discovered them, because I did make some money off of these guys. When I first discovered them, they were around the $4.50 mark.
Yeah, they're now up to 11.
Yeah. Well, that was the thing, is that when this tells you how long ago it's been. I was still working at Securitas, 5 years ago at this point. They were down around $4.50, and I bought in. I think I bought about 100 shares or so. And then I just let that sit because I was like, okay, I'll have, Oxford Lane, my monthly dividend, and then Great Elm I used as a quarterly dividend because that's what they do. I like to kind of, cover all the different sections of dividend payments.
Okay. Sorry to interrupt. I have to point this out for Great Elm. They have an F score of 1. That is not
Holy
good.
shit.
So the only thing that they're doing properly in the F score is they are making a profit. But they're not generating cash. They're not making more than they're reporting as profit. They're not more profitable than they were last year. Their long-term debt is increasing and not reducing. Their ability to pay short-term debt is not increasing. They are trading. They are having to raise funds from shareholders to trade. Their pricing power is not improving, and their costs are not reducing, and they are not more productive than they were last year.
Okay, so they definitely hit a slump. Hold on, let me see. Let me jump over to Grok again.
And they don't even have a Z2 score. That's interesting. It's just NA. Return on capital 4.1%. Return on equity 3.6%. Operating margin 33%. Their operating margin is good for
Yes.
in the total
Okay,
market, but really bad in their industry.
Okay, real quick. I just remembered this is what caught my eye about GECC. They're a business development company. So their whole thing is they invest into businesses, developing properties and so on and so forth, and financing for businesses.
Right.
So, yeah. Sorry, when you're dealing with so many different like weird name funds like Oxford and Orchid and Great Elm and all these different funds, you have to try to keep them all straight.
Yeah.
The thing with GECC, and this is just getting back to what I was saying initially. One of the things that caught my eye is that they had steady growth overall during that time period when I went into them. Again, I put like it was probably about $500 or something like that at that point in time, because if I remember correctly, it was around 100 shares that I bought. And then by the time, it was about the time that we were, it was about mid 2022 when we finally recovered. I did make like, I want to say, I think stock price was around 8.5 or something like that at the time. So personally made a chunk of change off of them for sure. But if they're having problems servicing short-term debt, like that's a big red flag for me.
Yeah.
Hey, give me a second. I'll be right back.
All right.
All right, sorry about that.
No worries.
But yeah, so now that you've told me that, okay, well, Great Elm can definitely stay on the back burner for buy.
Yeah.
That's definitely a hold.
Yeah.
Hold off on it.
Speaking of business development companies, have you heard of Oxford Square, which is not it's same people kind of who do Oxford Lane, but completely different fund that focusing wholly only on business development.
Okay.
I mentioned them just because I had heard about them recently. Actually, never mind. I just looked. Their F score is 3, so not great.
So never mind.
Yeah. So I found a very useful website called Stockopedia. Unfortunately, it's one of those you have to pay to use it, and it's like a couple $100 a month. But they give you free trials, and there is no limit to. They give you a 2-week free trial, and there's also no limit to the amount of email addresses you can make to get more free trials. So every time mine expires, I just create a new email address and get a new one, and it gives you access to all this information pretty easily.
Nice. So then the next one. Now this one is a particular interest of mine because I was holding this one back when I did have my initial investments. Plains All American. Unfortunately, again, I need to do new research on them to see what they're looking like now.
Plains All American pipeline?
Yes.
Oh, all right. Let's take a look here.
Yeah, it's a pipeline company.
Well, they just exited out of bullish territory, and now they're neutral. Not necessarily a bad thing. You don't generally want to buy when they're in bull territory. You want to buy when they're bearish.
Oh, yeah.
But yeah, let's see. They have an F score of 6, they have a Z score of 1.1. Meaning that they are in distress.
Well, yes, they've been in distress for years now, and this is the thing. So just for listeners' sake, when we went from capital funds to we talked a little bit about gold. We're currently in oil, and one of the things is that oil has been under attack as an industry for years and years and years now. And Plains All American, they own a lot of pipelines on the East Coast. But the problem is a lot of pipeline projects have been hampered in the recent years because of the Build Back Better agenda that was foisted upon us by the Biden administration, and the Paris Climate Accords and so on and so forth. Like, there's been a lot of restrictions that we're still cutting through a lot of that red tape and a lot of that bureaucracy to get a lot of these projects reapproved and get them underway. And Plains All American definitely got hit by that. So I do want to stress that when it comes to them being in distress because of obviously that Z-score is definitely bad. But to be frank, there's been a lot of bureaucracy that's been fucking with the oil industry for a while now. So, yeah. But, personally, I've been they were good. They back when I was invested in them. I think originally that price was around $11 when I put in, and then it crept up to, I think it was like 11 or 12 by the time I sold off, somewhere in that region. And if that's a quarterly dividend, if I remember correctly.
Yes. My main concern when I look at them is they have a fair amount of debt. They have about $8.2 billion in debt and a very low operating margin. They only have an operating margin of 2.7. So
yes, they unfortunately do have a lot of fucking debt that they have to service. And the problem is because there's been so little investment into the oil sector for years now, and now the constant EU attacks on the price of oil. What will end up saving the oil market is when the U.S. establishes a oil futures contract in New York, which I hope that happens sooner rather than later, to be honest.
Yeah.
But yeah, so I need to do some, we're basically doing the research now. But they definitely been in turtle mode for the past few years. I know that for a fact. I did read an annual report, I believe it was 2023's. Yeah, it was 2023's. I read that annual report about a year ago. And the sentiment was basically, we're turtling up and we're just trying to stay alive.
Fair enough.
But you also have to understand that this company is so valuable in general because it's like, pipelines are the easiest way to get oil and natural gas across the fucking country. Again, these guys were, some of the first motherfuckers that were out working on fixing their shit when Hurricane Helene fucking fell, because they're like, we got to get the oil running again.
Right.
And then, of course, there's the quintessential one when it comes to the oil sector, and I'll technically tie up with the oil sector with this one, Shell. And Shell is for obvious reasons.
Of course.
It's one of the most profitable oil companies in the world. It's one of the most well managed, and on top of that, it's just they're always about 6 months ahead of the curve across the board. Like they usually stay ahead of everybody, and a lot of companies will actually do this, where they will look at what Shell is doing and be like, okay, why are they doing that? We need to find out why they're doing that.
Right.
So Shell is, if you're looking for something that's a nice, robust company, Shell is probably the best one, to be completely frank. BP, fuck BP. don't go to BP.
Yeah. Though, for reference, Shell is also much more expensive stock. It trades at around $73 right now.
Oh yeah, absolutely. when it dropped to 69, I was pissed because it dropped down to 69 during COVID, and I was mad because I did not have I just did not take the opportunity to throw money into it, and I should have.
Actually, you want to hear something crazy? So a bit after COVID, 2021, it dropped to $24. I'm just looking at the I'm looking at the 5-year trend. Yeah, it was 24.46. Wish I bought that then.
No, what the fuck? Oh.
Anyone who invested then is going to be laughing now.
Oh my god, man. Oh my god. Oh wait. Okay, what the fuck? Oh, that was before. Oh no. Oh no. I realize. Oh, that's right. So it was late. Oh, it was $49. That's what I remember saying. It was $49. Because it was later in 2021 when I had the money squirreled away to throw into investments. That's what it was. It was 49, somewhere in that region.
All
right. But again, it's like, yeah, no. Anybody who bought in during 2020, you made out.
Yeah.
And this is why having liquid cash flow is important.
Very true.
So there's a few others. These are shit. I forget what they're called off the top of my head. The ETNs. These are the formerly Credit Suisse, now UBS ETNs. Mm-hmm. So this is in Swiss banking. I personally would not recommend investing in any ETN in Europe.
Of course.
But the Swiss bubble of European banking and stocks and so on and so forth, that bubble is relatively good. It's not perfect, but generally speaking, they're pretty good. And the symbols here, you have the oil ETN, which is USOI. You have the silver ETN, which is SLVO, and then you have the gold ETN, which is GLDI. Overall, the oil ETN is trading currently at 54. These are all monthly dividends, by the way.
That's good.
What are we looking at? Looking at for their
dividend is 3.76. So per share dividend, you get $3.76. Oh wait, actually no, that's dropped. That was 2020. It's now 2.81.
I'm looking at 2.49 for this month.
Oh, that's for this month? Huh.
Yeah, it's a month. It's a monthly.
Right.
So, overall, these ETNs, larger investment. This is basically this is just full blown oil, silver, and gold paper. Mm-hmm. If you're just looking for stuff that pays really good dividends and you're wanting to throw your money in, generally speaking, the Swiss banking bubble is not usually subject to a lot of bullshit because the Swiss pride themselves on their financial acumen and trading. So generally speaking, the only stuff I personally trust when it comes to Europe. Generally speaking.
Yeah.
If it's London or fucking Berlin, I don't touch it with a 50-foot fucking pole. It's like, nope, I'm good. Yeah, and actually, let me look at what we got going on. So, USOI again, pretty good return for price, honestly speaking. What are we looking at for SLVO? Oh wait, I gotta actually go to this tab. SLVO, why are you doing so bad right now? So if you invested in SLVO back 5 years ago, looking at a price of 148, and currently dividend is coming in at $1.06 for this month. Looking at a 20% return or 20% yield or distribution yield for the year. So not bad, but you definitely did not want to hold over the course of the past 5 years. Oh my God. That's almost biblical right there. That's a bad drop. Are you looking at SLVO's chart?
Let's see. Well, right now, at least from 1 year, it's higher than it was a year ago. That's not bad.
Yeah. Oh, yeah, absolutely. Look at the 5-year chart.
Yeah. So
Yeah, that's painful.
Well, highest it's been on the 5 year is 88.24, and it's currently 84.76. So I mean,
I'm looking at it at 148.
148.
It was over 100
for SLVO.
Yeah.
Huh. That's odd.
You might be seeing so real quick, I'll point this out. You might not be seeing the full 5-year data because remember, Credit Suisse was bought up by UBS. So you might be seeing the UBS data, not the Credit Suisse data included.
Actually, yeah. What I'm looking at is UBS AG, and then in bracket SLVO. So that.
No. So you're probably only seeing the UBS data, whereas over on Fidelity, the chart that I'm looking at actually does show all the older data. So I can see, we did peak up at 148, and now we're down to 84.76. Yeah. I don't remember where my dad bought in at. I didn't hold any SLVO back in the day. Well, actually, no, I did. I had I think I had 5 shares or something like that.
Mm-hmm.
I had split my money between SLVO and USOI, whereas my dad had gone hard into SLVO. And then GLDI, look at that real quick. So 5-year data on GLDI, currently sitting at 160. 5 years ago, it was 203. And then we're looking at a distribution of almost 16% on the yield at 288 for this month. So, and again, these ETNs, they're not bad. Again, the Swiss market has been under attack by the EU for fucking years. And the more the EU does to try to shore up their shit, the Swiss market suffers as a result. Right. And that's what happened with Credit Suisse. Is the Europeans attacked Credit Suisse, got Credit Suisse to collapse, and before they could swoop in and buy up Credit Suisse and take control of the Swiss market, fucking I don't know the full details, but basically Donald Trump walked in and told UBS, "Hey, you're going to buy Credit Suisse, bitch." And they're like, "Yes, sir." Which then, in effect, kept the Swiss bubble closed against a lot of the bullshit that we are currently seeing when it comes to the EU and a lot of their regulatory bullshit. Because what the EU is trying to do is they're trying to federalize. They're trying to come together as a cohesive unit in order to be able to truly challenge the U.S. And at the end of the day, all it's going to get the EU countries is, giving the ECB tax and spend authority, which I'm like, that's not fun.
So, speaking of distributions and whatnot, want to see something wild? If you're still in Fidelity, type up ULTY. See if you can find
ULTY.
Take a look at them's distributions.
All right, so we're looking at 635 This is Yield Max Ultra Option Income Strategy ETF. And we are looking at a 10-cent dividend. And you said these were weekly.
Weekly. Every week.
Jesus fucking Christ,
yeah.
that
yield of 117%. Now imagine compounding. Now imagine compounding that yield.
Oh my God! Hold on.
Yeah.
Hold on. Say, let's just go theoretical for a second. So they're 52 times 0.10 equals. So over a year, you would get $5.20. Let's say theoretically, at a price of $6.35, let's just say you have $1,000.
Oh,
so
and
at a price of $6.30.
Want to hear one more thing that might make your head explode? They're not taxed.
Go ahead.
Those dividends are not subject to capital gains tax. They're considered as return on capital, so you don't get capital gains taxes on those.
Wait.
Tax-free.
Well, they'd be considered income tax here in the U.S.
Oh. Are you sure? I at least from the brief I was reading, return on capital isn't taxed. It's only taxed when you withdraw, it's only taxed as capital gains, I believe. I have to do a bit more reading on that, but I don't think it was considered income tax.
So real quick, I just want to point this out real quick.
Mm-hmm.
So I did the math real fast, and so if you take, okay, so we just established, baseline 10 cents a week, 52 weeks in the year. That's $5.02 or $5.20. If you take $1,000, buy as many shares as you can at the current price, you'll end up with 157.48 shares for that $1,000. Times that by the 5.2, and it comes out to $818.90, basically.
Yes.
So what you end up having is that with this, your $1,000, you recoup it. If that's all you put in, you recoup your $1,000 within a 2-year span.
Yes.
Now we could, exponentially. So yeah, I'm definitely interested, and I'm probably going to check. You know what? I might just say fuck it and throw in, $100 and just fucking start on that one. Let me go ahead and add this to my watch list.
And just to confirm, what I was referring to is actually return of capital, and at least according to Investopedia, it's not considered income or capital gains.
Really?
Yeah, so it's basically tax.
I would have to find out more about that then.
Yeah.
Because then that creates a whole different dynamic than, that's weird. Because if that's the case, you're sitting, what? I am so confused. You hurt my brain.
Oh, all right. So
basically
what
you used confusion. It was super effective.
Yes. Okay, so what it means actually, it does get taxed, but only once. So let's say you buy $100 worth of it, and then you get $100 worth back in dividends. That is not taxed. It's only taxed once you've fully gotten all the money back that you bought into it. So if you buy $1,000, your first $1,000 of dividends not taxed at all. It's just considered returned income, or it's just considered returned money to you.
Oh shit!
Yeah.
Oh my God! Holy shit! What? What?
Yes.
What?
Yes.
That's what? How did they swing that?
I don't know, but I like it.
I like it a lot too. I might have to talk to my dad a little bit. Holy shit!
Yeah. So I basically, when I heard about this is what I moved all my OXLC money into. I'm like, fuck it. I'm gonna regain all the money I lost very quickly just in dividends.
Well, and that's the thing though, is that at the end of the day, when you're talking, at that point in time, so let me just kind of, financial strategy, generally speaking, you don't want to go for like when you're trading stocks, you do not, if you're not fully vested and fully in the game, there's a rule to follow.
Mm-hmm.
You want to go, 30, 40, 50% return. You don't want to try to go 60, 70, 80% return.
Right.
Leave a chunk for the god of greed.
Yeah.
Just leave it. Don't try to fucking hold out for those big returns because you'll get caught on the downslide.
True.
And so, generally speaking, the best option to do is you get your returns and then you pull your money that you invested out.
Mm-hmm.
So if you put $1,000 into something, you make back 2,000. You pull that 1,000 out that you put in initially, and you play with the house's money.
Right.
And so that's generally like if you're a retail investor and you're not like fully vested in this shit, and you're not checking it daily and hourly and every 5 fucking minutes. Like if you're a trader, you're checking this shit on a 30-second basis.
Yeah.
You clock in when the market opens and you clock out only after fucking 9:30, 10 o'clock when most of the after hours trading's in.
Yeah.
Now, mind you, if you're a true fucking psychopath, you clock out at, 12 o'clock and you watch for who's making the secret moves in the background. But there's very few of us like that in this world. But generally speaking, again, leave 20% for the god of greed. Don't try to fucking secure, the massive fucking gotcha money real fucking quick. Build it up over time. The difference between 5 years and 10 years is 5 years.
Right.
Well, what happens if you try to go for the, I want to get this done 5 years early? Well, then all of a sudden you go busto. And then you have to pick up from the beginning.
Mm-hmm.
So that's a cautionary tale for as many people as I can potentially reach with that. Leave 20% for the god of greed. But yeah, no, fucking holy shit. Being able to not just have your money basically given back to you, but non-taxable
Mm-hmm.
is actually fucking massive, because that means you get to play with the house's money for free.
Yep.
Because it's like, oh, hey, I got to pay taxes on, okay, fucking withdraw some money, pay the fucking taxes, and then proceed to go play with the house's money some more. Like, that's huge.
Yeah.
So, yeah, definitely going to be keeping an eye on that. Thank you for the the information there, bud.
You're welcome.
Hey, what's up, Gavin?
Hey, what's going on? Check and see what I put in news real quick. I just think it's interesting.
All right.
Sure. We're currently recording stuff about investing and whatnot. I think Dale's mic might have taken a shit.
Can you still hear me?
Oh, there you are.
All right.
Gavin, you got some white noise coming over your microphone. Can you mute yourself?
Oh yeah, hold on.
If this is true, Gavin, this actually ties into investments, by the way, boys.
You
If
think
that
this is the next? Well, yeah, these startups, dude. You imagine dropping a share into that?
Oh yeah, no, fucking drop $1,000 and fucking print money for life.
Yeah, it said they're already testing, or they're getting collaboration with France and stuff like that. So Europe is collaborating. 1,066 seconds. That's over 10 minutes of positive, which is insane.
Oh, is that, I thought it meant it was 1.066. I didn't know that was a comma. Yeah, that is pretty impressive.
Oh, that's a comma?
Yeah, I thought it was a point. I thought it was a period. So 1,600 seconds. That's a lot.
Yeah, that's a massive leap. I thought that tech was always 10 years into the future.
Mm-hmm.
Well, again, I'm just saying here, and all I can say is that if they have managed to come anywhere close to it, then it's like, well, there you go. Again, like the financial rewards from this will be fucking insane.
Oh.
Well, if investors and venture capitalists see the potential in that.
Yeah. Oh,
yeah.
Speaking of investing and future technologies, if you're still on Fidelity, check out QTUM.
QTUM.
Yes.
Defiance Quantum?
Yeah.
Right?
It's basically
look. Oh. Hey, Gavin, your microphone, dude.
It's the fan. Sorry about that.
Yeah, it's just when you're not talking, you gotta mute, dude. All right, so 94.81 currently.
5 years ago, it was 33.
Jesus Christ.
Yeah. And
I'm looking at it. Oh my God. So hold on, let's see. So we reached a peak at 55 in December 1st of 2021. We hit the bottom of the floor September 1st, 2022. Then we peaked again at 53 July 3rd, 2023. And notice, okay, so it took them about 2 years to hit their big high there, 55. And it took them less than September to December. That would be 9 months. So it took them 9 months to hit a floor at 36. And then it took them another 10 months, so almost a year to regrow back to where they lost. What's the information we got on this ETF?
So,
what are they specifically investing in, and so on and so forth?
Research and development of quantum computers.
That's
why it got my attention, because assuming those are actually a thing, there's going to be a lot of money in them. Honestly, I don't know much else. Like this thing I just heard about earlier today, so I don't know that much about it other than that it's quantum computers. It's basically a fund of a bunch of companies that work on quantum computers.
So they seem to follow a similar pattern to pharmaceutical companies. Funny enough. So it looks like they go through a massive tranche of development, and then they have a valley where basically, considering the potentials, you have a slack in development. There's not as much headway being made, and then there's some headway made, and so they grow in price, they come back down, and then they climb back up. Trade, that. What was that? Hold on. 1, 2, 3, 4, 5, 6. So they traded sideways for 6 months, and then massive jump up into the 82 range. What happened? What I would love to know is what happened in October of 2024 to cause a massive meteoric climb into 82 from 62. So we're talking $20 increase here. So we're talking a 33% increase in price.
So around that time, it was announced, basically, that was when it was announced, and I remember this because I was talking to a friend about it who was staying at my place around that time. That was when it was announced that quantum computers could, like, crack any encryption in, like, fractions of a second.
Okay. So that was that. Okay.
Yeah.
So at that point in time, they seem to have stabilized their price, and it definitely looks like, from the ETF point of view, that everybody kind of agreed, like, hey, the high 50s, low 60s was kind of where we thought we should be anyways. And then that news comes out, causes a big boom in the price. Now it did come back down so from March and April. So we started to have a slip in January, into February, into March, April, and then started climbing back up in May. By May 1st, reading that you recovered what you lost the 3 months prior, 4 months prior, and then now trading up in the low 90s or mid 90s, starting to. So it definitely looks like something that would be beneficial, but given this is definitely not a dividend stock.
No,
because
this is a growth
they're
stock.
definitely not paying. Yeah, this is a growth stock or a growth option through and through. So honestly speaking, if they fall off again here in the next 6 months, I would say more than likely it would be a good buy, just to get in that dip and then ride that wave up the next time.
Yeah.
And you basically just cyclically trade these guys. That would be my play with this.
Right.
Another small stock to possibly toss some cash in would be the startups collaborating with Elon right now for mining in space.
Most of them are not publicly traded.
They're not?
Yeah, most of them they haven't IPO'd yet.
See, I thought they already did.
There's a couple that have, but most of them haven't.
Got you. Yeah, I just had some stuff come over on that. And I hadn't looked into their actual portfolios yet, but yeah.
But yeah, so now that we've kind of gone over some things, and we I went through my stuff. Dale, you've indicated what you've tossed money into.
Yeah.
One of the things that I truly want to emphasize about this conversation is that we're the first and foremost thing that you have to understand as an individual when you're talking about wanting to invest and wanting to put money into things in order to be able to grow that capital, because capital that sits in your savings account is worthless. If it's sitting in a savings account, you're literally doing nothing. You're just saving. The problem with saving is you save food, you don't save money. Money needs to move. So, first and foremost, that's my mentality. But I think it's played out pretty well across the board. Figure out the best way to get your money moving. Figure out the best way to understand what you need your money to do for you. But then the next thing that you also have to identify is how much fucking debt do I have?
Yeah.
You know, there's so many people in the world that are complaining and bitching and whining and crying about how, you know, things are too expensive and that I don't have any money, et cetera, et cetera. And if you get a rundown of assets versus liabilities, you realize the liabilities outshine, you know, what's the debt to GDP ratio of the US again? It's like what, fucking 1,000%. You know, that's what most people's fucking asset to liability sheets look like, anyways.
True.
You know, these poor sods that buy these fucking houses at ridiculous prices that have ridiculous loans. You know, yeah, you're gonna be out a shit ton of money for a while, dude. You know, if you buy that, you know, you could have bought the Toyota, but instead you bought the fucking BMW. You know, different shit like that. So, you know, manage your debt, and then also understand where the fuck your money needs to go in order to make it work best for you. That's my overarching argument.
Right.
And I don't think I'm off base with that at all. Like, you know, there's plenty of people that are bitching and whining and crying, like, oh no, you need to start up an AI company, you need to be doing this, you need to be doing that. And it's like, okay, no, you don't. There's plenty of other shit to be doing. You know, you might, like me, I'm not code savvy. I'm not code savvy whatsoever. And me trying to get into tech is, okay, I won't say I'm not code savvy. I can look at code and kind of get a general idea of what the code is intended to do very fucking easily. Do I enjoy doing it? No, not at all. I fucking hate doing it. I fucking hate coding. And the whole AI thing, yeah, you know, you can get into it, and if you can create a virtual intelligence that is on par or better than Grok or ChatGPT, then good job. Have fun. You'll make some money. But at the end of the day, it's a VI. It's not AI. So,
well, having a marketable skill to begin with, you want to look for a niche and try to look for something that somebody needs. That's service right there. And find something that you're good at that costs the least to get into as soon as possible.
True. Oh,
yep.
Also, just a bit unrelated, but since you were talking about AI, something I thought you'd find amusing. So recently, there was this kind of highly regarded AI company out of India that went out of business, and it turns out that it wasn't an AI company at all. It was just employing 200 Indians to pretend to be AI.
Yes, I am aware of that shit show.
How many Indians does it take to be a floppy disk?
Well, apparently 200.
That's incredible.
Yes.
No, like me being
200 Indians and scripts.
Yep.
Me being in the service industry myself, because I believe a skill set, it's something that nobody can take from you. It's something that you possess that costs you nothing to have.
Mm-hmm.
Generally, licensing is pretty minimal. Tools are not terribly expensive, whether you're in digital or whether you're in manual labor or what have you. If you could do something like that can bring in cash and your overhead is minimal, and then you have all of that capital just sitting, and you can invest in, and if you have a service related cash cow, your next thing is to get into real estate, because you can use your service abilities or your service resources to keep all your money in-house as far as your upkeep. Mm-hmm. And then that service can also double as bringing extra cash into your supplemental income from your investments. So
Well,
as far as hard capital, which I think the realest capital right now was always going to be land and property. You can't go wrong with that particular long-term general goal. And then if you can get that machine rolling with some properties and a means to keep as much money within those properties as possible, then you take what it's turning out for you, and you can drop those things into other industries, particularly oil.
Well, and that's the thing, is that I don't disagree with you. Like, if you want to go that route, absolutely. But I'm talking more in a general sense, that if you can find some way to make your money fucking work instead of just sitting in a savings account, you are going to benefit more from it in the long term than you are, period, in a story. You're not benefiting.
Yeah, exactly. Even if you're making an extra $100 a month, dropping it into a coin. Yeah. Instead of dropping it into a bank, put it all on a coin, and then just pay attention to your coins, move them over to the one that's upticking,
Well, and again, just because, arbitrarily, because the SEC and all them assholes, this is not financial advice. But even then, the whole point is that at the end of the fucking day, just getting the money moving and your capital actually doing something for you, like, it's something like, what's the poverty rate in the U.S.? It's like, what, 4%, 5%, something like that.
Yes.
When your poverty rate borderline matches your fucking unemployment rate, you're doing pretty fucking good.
Yeah.
The United States is in a wonderful fucking position, especially if we can get rid of and deregulate the shit out of the bureaucracy that we currently have. The ability for people to make money is fucking boundless. The problem is when that money sits in a fucking bank, it is worthless.
It's because people are still practicing, or they're still stuck in this Dave Ramsey way of thinking with cash. And
absolutely.
Right now, money as we see it in fiat it's a machine. It's not just a hard asset; it's a machine that moves.
Yep. Well, that's just economics in general. That's just the market.
Yeah.
You are a cog in that machine, and if you're not spinning and producing with it,
yep,
then you're just going to be a dead leg.
Also,
and that was
I checked the poverty rate according to the last released metrics is 11.1%.
11?
Yeah, 11.
11. Oh.
Okay, that's a little on the upswing.
It's actually lower than it's been for like it's the lowest it's been since 1959 when the start of the chart. So, yeah, apparently it's all.
What am I thinking? What am I thinking of?
Historically, it's hovered around 15%, but now it's 11.
Oh, no. Okay. My bad. I just realized what I had done. I was thinking of, I was just watching a video last night, and this is because I was researching some stuff yesterday, and then last night I watched a video in regards to Chicago.
Mm-hmm.
It's something like, if I remember correctly, it was something like the poverty rate in Illinois is something around like the 5% mark or something like that.
All right.
Now, that's probably.
I say there's no way Illinois is outperforming Ohio.
Wouldn't doubt it, to be honest. With how much capital comes through Chicago. I'm trying to remember, like, where did I get 5% from? Just trying to remember that. I feel like it might have been a video. But the video might have been fucking long, to be honest.
Well, I guess Chicago alone could outperform a good several percent of the country.
All right, so I just checked. Illinois, the GDP is 1.13 trillion, and Ohio, it's 852 billion.
Okay.
Yeah, they're definitely outperforming.
Yeah, Illinois ranks 5th, and Ohio ranks 7th.
Got you.
And what's the poverty rate of Illinois right now?
One moment. The poverty rate of Illinois is 11.6%, so it's slightly higher than average.
Oh, okay. Fuck, what was I thinking of then? God damn it. Now I'm fucking frazzled because I'm like, what the fuck was I reading?
Whoopsie.
Yeah, no, I'm just like, what the hell?
My metrics are dreams.
Yeah, dude, honestly speaking, I might actually, I might have been thinking about numbers last night, and that's why I got fixated on. Yeah, dude, it's happened, by the way. I have done that before. But anyways, the whole point is that, again, you literally, you are part of the market. The market is you. And if you are not moving and doing things within the market, you're unproductive, and thus you're not going to be able to do anything. Your money, the cash that you have access to, is part of you. And as such, you have to keep fucking moving. You have to have it keep doing something. Otherwise, you're screwed. Take 5 for a second. I gotta walk into the cooler.
All right, no worries.
It's just loud as shit in here. And it feels great in here after walking outside. What you doing, Abe? Oh. Actually, okay, a little longer than 5. I gotta walk around the rest of the building and get back to the guard shack.
All right, have fun with that.
Yeah, well, it doesn't take me long to do. It's just I gotta hit specific points for my patrol report because they want pictures, and so what I decide to do as part of my patrols, I take pictures of the temperatures on the cooler deck and in the freezer deck to make sure that it's like, yes, everything is in order. Don't worry, everything's good.
Coolers are supposed to be between 35 and 45. Freezer's supposed to be 0 to 25.
34 to 44, and then -10 or no, -4. Oh no! What are the policies again here? 34 to 42. That's what it is. 42, and then the freezer is supposed to be anywhere from, I believe, -6 to 2.
-6 to, wow. That's a deep freezer.
Yep, they keep this shit cold as fuck.
Now, I worked on some old freezers for gas stations for a while.
Ugh.
All right. So as we're coming up on an hour and a half, I think there is probably a good place to end it.
Yeah, fuck it.
All right. So see you next week, everyone.
Yeah. See ya.